Welcome to the Market Profile Lesson, Nuance 3. Poor high or low does not necessarily have to be a weakness. You will learn to read context, where a poor high can result from a one-sided auction, dominance, or liquidation, signaling strength, not weakness. This nuance teaches you to distinguish between structural deficiency and behavioral superiority. When the market creates a high for more than one TPO, we call it a poor high. Traditional interpretation claims no excess, implying the market will return for an unfinished auction. But this applies only in a certain context. A poor high can arise when the market liquidates the counterparty, or the auction is one-sided with no pushback. It can also occur when the market is driven by a mechanical participant who seeks efficient output, not excess, or when market psychology is done for the day and participants do not expect a higher price. The result is a high created by several identical TPOs, without excess, but with clear dominance up to this point. It is crucial to understand that not every poor high is weak. Weakness is an unsuccessful attempt to break through. Strength is characterized by no need to raise the price further, indicating that business is done. If the market stops without rejection, but there is no one on the other side, there is no reason to go higher. If the movement was aggressive and one-sided, a poor high can represent a target point where dominant participants completed their activity. Also, was there follow-through without reversal reactions, and were there weak counter-returns or no absorption? To discern whether a poor high signifies strength or weakness, consider if the path to the high was clean and without rotations. Finally, was momentum exhausted without resistance? If yes, the poor high is not weakness. It is the end of initiative, not a failure. For example, in an initiative trend day up, the market rises without interruption, and the poor high arises as the culmination of a one-sided auction. Another example is a liquidation movement without resistance, where shorts close, longs hold, and the poor high becomes a mechanical peak. On a Fed or earnings day, the market might reach a zone and stop moving higher, not due to selling pressure, but because there is no counterparty present. Common misinterpretations include assuming that a poor high automatically means you should short, or that the market must return there for unfinished business. These interpretations overlook the crucial element of context. If the movement was one-sided and clean, a poor high can be proof of dominance. Furthermore, a return to that level is not always necessary, as market-generated information has already occurred and the signal has been delivered. Traders often seek excess because it provides certainty that a market movement landed well. However, the market's primary objective is not to look good, but to be efficient. A poor high, when interpreted correctly, conveys a clear message. I had no resistance. I did not have to go higher. I was done. In summary, a poor high is not automatically a sign of weakness. Context is paramount in determining whether it signifies a failure or a completion. Trend days frequently conclude with a poor high or low precisely because of the absence of a counterparty. The biggest mistake is assuming the market owes something simply due to the absence of excess. Ultimately, it is essential to learn to read the intent, not just the shape of the market profile. Bang!